What's up, Gould Miners? Danny Gould here. Wow, have I got an episode for you guys. This is an incredible episode. I cannot say enough good things about Elijah Brown. This dude's the real deal. He's one of the more impressive people that I've interfaced, not just real estate investors, but one of the more impressive individuals that I've interfaced with. And he's done this at such a young age. 7 years ago, Elijah was still in college. And over the last 7 years, he has gone from zero to now having an equity position in over 2,000 units. And he did that primarily through running a fund of funds model. And in this episode, we're going to go over how you, if you want to take a active route, how you could start a fund of funds, or if you are more of a passive investor, what the benefits are to investing into a fund of funds as opposed to going directly to a syndicator or going directly to private equity, what the benefits are to investing into a fund of funds like Elijah is running. And that's just the tip of the iceberg. We cover a wide gambit of things in this episode, and it is just a treasure chest of information. So without further ado, everyone, Elijah Brown. Elijah, welcome to the Gould Mine.
Thank you. It's a pleasure to be on. Did you make sure you hit the record button?
I did.
Awesome. All right.
We are recording, baby.
Great.
So I've been watching you on these podcasts. I didn't know you say, there's not a lot of them, or like you didn't realize anyone watches, but people do watch, my friend. People do watch. And I am impressed because you are relatively young, and most people do not get into real estate investing this early in life, especially to this degree. When did it all click for you?
So I was in college and I was going through investment banking recruitment pipelines, and I was applying to all these jobs, and I got really lucky and ended up landing an internship at a hedge fund. And so I got the job, started working, and realized very quickly that I was definitely not interested in that space, that sector, that industry, and I needed to do something else. I definitely didn't want to go into an actual investment bank because I didn't want to lose my sanity, and I didn't want to work in equities trading either. And so late one night I was watching a ton of YouTube. And these are channels like Bigger Pockets, Chris Crone, Phil Pustajovsky, Graham Stephan, some of the names that people are familiar with. And they were talking about rental properties and real estate and how that was the best way to create wealth, and it created the most millionaires, and it was just the best option that they had found. And so I just devoured a ton of content on YouTube. And after about a few weeks, I realized that my calling in life was to be a real estate investor. That was the moment when it clicked, and I made a decision right then and there to go out and buy my first rental property.
Just like that, huh?
Yeah. I was like, just take action immediately. Like, I've always been a big fan of like not reading books and instead going and doing deals. So that's like my thing. Yeah.
Learned through trial and error, learned through experience.
Yep.
That's you and I are very similar in that way, because one of the things that I do very frequently is like when I want to do something, like I make the decision right away. So it sounds to me like you are very similar in that capacity, where it's like when I want something or when something clicks for me, I just go for it. I don't wait around for someone else to give me permission to do it.
Yeah, it's very good. Like you have to get to a I so that you're not like introducing a ton of risk. But at the same time, you'll learn the most by just going out and doing the deal. I like to say that like ignorance is actually like a good thing. Like being like naive and ignorant, looking back on it, it's like, wow, some of the things that I did in the beginning were very risky. Like if I could go ahead and just put on a pair of rose-colored glasses right now and go back to being like dumb, stupid, and willing to take risks, like I don't know, like I could be so much further now. But it's funny because now I understand risk, and some of the decisions I made in the beginning, I probably wouldn't do right now. Does that make sense?
100%. So let's talk about that a little bit then. What would an example of that be?
Let's just take the first rental property that I ever bought. It was a simple 3-bedroom house in Orlando. It was like $144,000. And so we actually worked with like a kind of a turnkey company that would, introduce us to the agent, crunch the financials for us, pick the market, introduce us to the property manager. And so I pretty much relied on the financial model that they provided, the pro forma of the cash flows, because I didn't know any better. I had not yet learned how to underwrite and do the numbers myself. Looking back on that deal, and I've pulled up that model a few times, wow, that was just so far off. Like, the deal wasn't going to work from day one. It was never going to work. And we were very, very lucky that the market was so hot, and we ended up making money because we didn't distribute $1 of cash flow. In fact, multiple times throughout the 3-year ownership of that property, the partners, me, my cousin, and my best friend, we had to contribute capital. We had to make officer loans just to keep the thing alive. And so just looking back, it's like, well, would I have bought that property now? Absolutely not. Definitely not. But am I glad that I was dumb enough to buy it then? Absolutely. Like, that was the best thing I could have ever done. Even if I had lost money, it would have been worth it because now I have, 2,000 plus units in the portfolio. So.
Wow. So over 2,000 now, because originally, so
it goes up by a couple hundred every month, just because we're doing so many deals. Just so people listening understand, I don't own these buildings by myself. I own maybe like a very, very small portion of it, like 0.01% or something like that. It's so my unit count is going up exponentially, but my actual equity in these deals is going up at a more linear rate.
Makes sense. Yeah. And that's what we can definitely, I want to explore that model, or like kind of explore the fund of funds model that you're running right now.
Sure.
But before we do that, I want to kind of go back to that first lesson, and then what got you from owning a single family home in Orlando. And that wasn't that long ago either, right, Elijah? I mean, like, that was
like 7 years.
Okay. So 7 years. Yeah. So in 7 years, you scaled from 1 to 2,000 plus.
Yeah.
It's a big leap. Walk us through that journey.
Sure. So in order to really scale a portfolio like that, you can't stay in the single family world forever. I did 4 single family rentals in Florida. And then a mentor at my place of employment, the guy who actually hired me, he recommended that to scale my portfolio and to take advantage of all these additional benefits, I needed to start buying multifamily properties, getting those economies of scale, being able to force appreciation, all the good benefits that we can talk about for hours. And so I took his advice and I started working with brokers in the area, and we found a 6-plex. And that was the first multifamily that I got into. And, back during this time, I was doing like all the work. I was coordinating with the brokers, sourcing the debt and the equity. I was finding property managers and contractors and doing everything myself. And it was brutal. And so I did a few of those. I did a 6-plex, then a 5-plex, and then I played a lead role on a 50 plus unit apartment building in Colorado. And then did it again on a pretty large portfolio in Vermont. And it was just like, I was playing such a large role in these deals that I was just like getting burned out. And I realized really quickly that I just couldn't do this forever, and that I wasn't really good at everything. I'm still like not really good at all the components required to do a real estate deal. But I was really good at a few things: underwriting and investor relations. I could crunch numbers and build Excel models from scratch because I learned that at my W-2 job. And I was really good at making relationships with investors and raising money. And so I made the decision to bring those skills and focus on those skills. I would bring those skills into other companies and partner with other much, much, much larger companies on their deals. And so I would play a much smaller role on a much bigger property. And so I'd be doing, underwriting and investor relations, and the company I would partner with would do literally everything else. And then I would get my fees for doing that. And that's how I was able to scale from like a 20 to 30 unit portfolio up to like thousands of units by just playing that much smaller role on the team.
Love it. And so let's talk about those skills that you developed while you were working for, it was a hedge fund, or it was a REIT? Or
it was a REIT, so real estate investment trust, essentially just a public real estate fund.
Yep. So What did that training comprise of, and how has that served you to date?
There were a number of things that I learned there. Day one, when I showed up, my boss took away my mouse and essentially put a blindfold on me and said, you need to learn how to use Excel and the entire computer without a mouse. So that forced me to learn all the hotkeys and all the formulas and everything. And I essentially became an Excel wizard. He had me take like a Wall Street modeling course, which was like a 3-day thing. And I essentially learned how to like build cash flow models to underwrite deals from scratch. So that was extremely valuable. That helps me understand risk in a deal and like be able to know what the various inputs and outputs are so that I could propose things to investors. The other thing that I learned, which a lot of people don't really understand unless they do it, is the whole like corporate experience and being able to like sell yourself in that type of environment. I had to make multiple presentations to like investment committees and C-suite personnel, senior vice presidents, executives, and just being able to essentially brief people and prepare a professional product, ahead of time that exceeds the standard, and everything like that is just super invaluable. Also, just being able to speak like corporate lingo and understand like the whole private equity investment world. And in that case, it was public. But just knowing the language of the industry is super valuable. So there were a lot of things I learned from that job.
That's really interesting. I'm curious because you transitioned from the REIT into now running your own business, right? And so through that time, you were growing, you were scaling the portfolio, you were presumably syndicating these deals, correct?
So nights and weekends, whenever I wasn't at work, I was spending a lot of time finding my own deals and pitching my own deals and managing my own deals.
Did you? Well, I'm sure you did, because when you started this, you were what, like early mid-20s? Now
I was still in college. Okay. I think I was like 19 years old, I think, when I bought the first one.
So on the come up, and perhaps even now, you might be running into investors that are maybe concerned with like your youth, right? So, or not lack of experience now, right? But how did you tackle that objection, right? Because someone looking at you saying like, you're 20 years old, like, how am I going to trust you with my money? Like, how do you tackle that?
Yeah. So like in the beginning, and this really applies to like anyone looking to raise capital, regardless of age, when you don't have a track record and you don't really have experience, the only people who are going to trust you with their money is really like friends and family, maybe some coworkers, people who are close to you that trust you just because they know you very well. So, I started off, I did like 5 to 6 years of just raising capital from friends, family, coworkers, people who were like close to me within an inner circle, maybe like a total of like 50 or 60 people that I would, send deals to. And so that's really how I got started. I always came off with like I was always professional about everything I did, from like the PowerPoints to the models to how I explained deals and how they work. I got obsessed with making money when I was 12 years old. And so I've kind of been on this path of like becoming the expert professional at whatever, real estate, finance, anything. And people around me knew that. And so I was able to build my track record with money from those friends, family, and coworkers to the point where now I raise money based on my track record, not really my age. So it's not really an issue. If anything, I think growing out my beard helped a lot because I looked like I was 40 years old. But
that's funny. That's super funny, man. I wish I could grow a beard. I think that a lot of my issues would like suddenly disappear. Yeah. I am much older than you.
It helps.
But it's just like baby face, and it's just like, oh man. But that, and that's, I'm not sure how much parallel there is here. And I would say that sometimes, kind of like going back to, those rose-colored glasses, when I got into real estate sales, so slightly different. I realized that my youth was going to be a detriment to some extent, right? Some people would look at me and they would think differently or less of me for just it's human nature. And so I decided pretty early on in my real estate career that instead of avoiding it, or instead of like not talking about the elephant in the room, I'd lean into it, right? And so I came up with basically, a pitch, right? And so when I would go in to interview for a listing, when I go in to interview with the seller, I would ask them, or I would let them know. I say, hey, I don't know if you know this, but the average realtor in Santa Clara County is over the age of 60. In fact, it's somewhere around 65 years old. Did you know that? And so they'd say, oh, no, I had no idea. Well, you and I just talked about who the avatar is for this house, right? And so you and I both agree that this is probably going to be like a young tech couple with maybe a kid, but probably not, right? And so who do you think is closer in age and psychology to your prototypical buyer? Your average agent here in Silicon Valley or myself? And of course, they'd always say me, right? And so I found a way to leverage my youth as an asset, not a detriment. And then I was able, like that, I would take listings left and right by using that, by switching up the frame, right? And I think that the same thing could apply with capital raising, because the truth is, Elijah, your youth is a huge asset because you don't have any responsibilities outside of making sure that your investors' money is well taken care of.
And I'm hungry and I'm willing to work
100%. 100%.
So my philosophy on that has always been like to not really give the age thing light of day, and instead just like impress them with my experience and my knowledge and like the actual product itself. 100%. And then, if it happens to come up as an issue, which it actually never has, if it happens to come up, then I can address it. But it hasn't been a problem, surprisingly. And I always thought it would be.
Yeah, well, and I think to your point, it's because you took the time to develop a track record before you went out there and sold to the masses. And I think that already set you, like you didn't need, like people looked at you and they were like, oh, well, look at this portfolio. It's like, this guy's a winner, right? And people want to work with winners. And yeah, man, so that's awesome. So let's flip the narrative here a little bit, or flip the script a little bit. And someone's listening to this right now. They're like, yeah, that's great, but I don't have any money. This all sounds so great, but like, I don't really have any money right now. So what would you, what words of wisdom could you give to that person to like inspire them into action?
Yeah, I had no money when I got started. And so from day one, I had to bring in partners to make these deals happen. So on the very first deal, I called my best friend and my cousin. I said, hey, I've been watching all these YouTube videos. I'm going to buy a rental property. I'm going to send you like 100 YouTube videos. Once you're done watching them, like, let me know. So they watched the videos. They came back and I said, all right, how much money you got in your bank account? And I convinced them each to like put in $10,000. And between their 20,000 and my 20,000, we had enough for a down payment. So there's always ways to figure it out when you don't have money. Bringing in partners, doing creative types of financing, such as like seller financing or zero down loans or whatever you have to do. And then the other thing is, if you're interested in getting into like commercial syndication, you can just bring your skills or whatever you've learned to that deal without contributing anything financially to the deal. And you can even get paid for providing those services. So you can start building your track record and being part of deals and even making money on deals without having any capital invested in them.
Let's dive into that a little bit more. Why don't we list out, like we can brainstorm right now, like what are the skills that someone can bring to the table for this for a commercial syndication?
Okay, so I'm just going to start with the two that I got good at, which was underwriting. So this is like pro forma, Excel, cash flow modeling, crunching all the numbers to figure out if the deal is viable. Mm-hmm. Then there's investor relations, so raising capital and managing investors and keeping relationships with investors. That's super important. If you know a bunch of wealthy people, great. You're extremely valuable to a syndicator like me because you can source capital for my deals, and you'll get paid for that very well. Actually, raising capital gets you the best compensation for the amount of time that you spend. Real estate agents are making 3%, 4%, 5%. Yacht brokers and jet brokers are getting 10%. Within syndication, equity brokers, capital raisers, they can get anywhere between 10 to 30% of the amount of capital that they raise. A small portion of that is upfront. Most of it comes on the back end in the form of a profit split, but still, it's a very, very lucrative way to participate. The other jobs that you can play on the team, the other roles are asset management. So who's going to be managing the property manager, making sure that the tenants are taken care of, that the units are being leased. You can be a construction manager. You can manage the crew that's going in to renovate. You can do CFO services like preparing financial packages. You can manage the investor portal to do distributions. You can be the email marketing guy who puts together the email campaigns and manages all the incoming leads that come in. Another one, you could be the thought leadership guy. That's now my primary role. The guy who's going on social media and creating TikToks and LinkedIn posts and whatever to attract new investors into the deal. So there's just a lot of ways that you can add value and be part of a team. You just need to figure out which one you're best at, learn how to do it really well, and then approach these companies and let them know that you want to be a part of it.
Yeah. So just to recap there, thank you. That is a really and some of these I didn't even. Like the thought leadership, especially. And some of these roles can be combined, but to break it down like that is super valuable. Yep. So we have underwriting, we have investor relations, and coupled with that, capital raising, asset management, construction management for properties that need rehabilitation, CFO services, marketing and sales, and thought leadership.
Legal, tax, brokerage. There's you could think of, there's anything. And then the most important one that nobody ever says is the leader. So, and this is, I want to spend some time on this. This is like the most important part. It's the person who's going to bring all of these different people together to and motivate and influence the organization to actually get the job done and accomplish the mission. This is what I do. It's like a visionary role. My goal is to not be the implementer. I don't want to be the one in the weeds of the business doing the actual tasks. I want to be the leader who essentially manages and, motivates other people to do all the work. I'm a visionary. I'll sit in a hot tub and come up with ideas, and then my team will implement them. That's the ultimate, any entrepreneur who becomes extremely successful and wealthy, at some point in their career, they have to stop doing the actual tasks and just be a visionary and a leader. And that's really what sets the great apart from the average.
I really want to spend some time here, actually. So this is great. I first of all, when you say words like visionary, I can't help but think, have you read any of the EOS books or Traction?
No, but I did listen to the author's podcast appearance with Bigger Pockets with Brandon Turner.
Yeah.
So I think that kind of inspired me a little bit.
It's a great system, and I do run it for Selling Silicon Valley, my real estate team. So it's a good read. I would highly recommend it. It just helps, even if you don't run it necessarily, Traction is a great book. So just for anyone listening and for you. So this is okay. This leader of the group, right? And obviously, they don't necessarily just have to do the leadership role. There's other things that maybe they would either oversee or be directly involved in.
Definitely.
What does that? We talked about baseline, and that's something that you said earlier. Because this is something that I think a lot of people struggle where they'd like to do that. That sounds great, but it also sounds very pie in the sky because it's dude, I still have to pay bills, right? Yeah. So then how does one transition into that role, right? How does one kind of get there? Because it's not you just wake up one day and you decide that that's the case.
In the beginning, you really have to like bootstrap it, and you as the entrepreneur are playing like all the roles, and you're working extremely hard to like set up the business, get it like minimum whatever profitable, establish your SOPs and your processes and your automations for the business, with the whole goal of getting it to a point where it's making enough money that you can start replacing yourself and, you know, moving on to your highest and best use, rather than doing those, you know, $25 an hour tasks. You need to be, you know, figuring out how to get to the point where you're doing your $1,000 an hour tasks, or just, you know, being a leader. And in the beginning, you can't do that. You have to start somewhere. You have to learn all the different roles and get a baseline understanding for what all the jobs are. Like, I played all the roles in the beginning. I did that for like 5 or 6 years, so that you can effectively like influence and motivate people within your organization to do those jobs. You have to be able to do them yourself to some degree, so that you know what they're doing. Yeah, I'd say for me, like, I'm still in like the transition phase where I'm doing like a lot of the tasks still, and I do have a partner who does a lot of the tasks as well. But, you know, our business is making money, and we are just constantly thinking about what type of like automations can we put in place here to replace ourselves? What kind of people can we hire to do these tasks and replace ourselves? Because I want my day to be spent on trying to figure out the next best thing, the next direction for the company, the big grand vision for like where we're going. I should not be putting together email campaigns and, you know, like jumping on Zoom with new prospects. That's just the reality. Like, my time needs to be spent thinking and coming up with new ideas.
Everyone that's listening right now that is asking themselves, how do I get to that level, should take note that what Elijah just said is, I grinded my ass off for years. Yeah. And then eventually one day I got to delegate a lot of those roles and responsibilities, because it didn't happen overnight. And I think it's also it's a really good point, and something that I learned, you know, with the team that I built on the residential side of things, which is, it really does pay as a leader to have a base level understanding of each role. And I think that sometimes people think delegate, and it's like, I'll delegate it and not have to worry about it anymore. It's like, no, there still needs to be some sort of like oversight and like some base level competency on your end to know whether or not the job is being done effectively or not.
Jocko Willink described this in his leadership strategy and tactics book that I just finished reading. He's like, you need to like have like a very like basic understanding of what everyone on your team is doing, so that you can hold them accountable and quality control what they're doing. Otherwise, they could be doing like literally anything, and you just wouldn't know if they're, you know, doing what's necessary to effectively accomplish the mission.
I love that. What's the name of the book? Do you know?
Leadership Strategy and Tactics. Jocko Willink.
Yeah. That's cool. I'll have to check that one out. I've listened to some of his stuff, but I'm very like, I've not like really dived into Jocko, but you'd recommend it.
Yeah, definitely. I mean, it's for me. So I'm a military officer. I'm in the Army Reserves, and so like that book and the stories and the language that he uses resonates, you know, very well with me, because I'm in that world. But I think it really applies to anyone who wants to be a leader, wants to be an entrepreneur, wants to do anything great with their lives. It's really just an awesome motivational book with some like really like specific things that you can do to improve your leadership skills.
That's awesome. And you know what? I gotta say, I can't think of a single piece of content that I've consumed that has actually talked about your military experience. So I'd love to hear just a little bit about that.
Sure. Originally, I joined the ROTC department, which is the Reserve Officer Training Corps. It's a program at college where you can train for 2 to 4 years. In my case, it was 4, while I was studying for my bachelor's degree. And then they'll pay for school. They'll give you a full tuition scholarship. I went to USC, the University of Southern California. It was like $400,000. They wrote a check for all of it. in exchange, I owe them 8 years after I graduate. So you commission as an officer in the military, and then you can either do it full time as an active duty soldier, or you can go into the reserves with the National Guard, which is just a 1 weekend per month and 2 week per year commitment, which is what I've done since I commissioned. So, every other month or every month, I'll go, fly out to California or wherever and do my weekend of service. I actually just returned from Fort Leavenworth, which I was at last week for a 2 week period of training, and so that I'm paying off what I borrowed essentially from the government to go to school.
That's awesome. And what lessons have you learned through your experiences in the military that have translated into your current role as a fund of funds manager?
At first, I was just like angry that I had to be there, and it's not like glamorous and fun. Like 99% of what you're doing is like sitting at a desk at a computer, either doing paperwork or reading some kind of manual or doing something you don't want to do. It's not glamorous. And so in the beginning, I like really resented it. But as I've gotten into more like positions of leadership, like actually leading teams, sections, doing things that are more important, going out on exercises and actually being in charge of groups of people, I've learned so much about like leadership and managing people and getting people to do things that you want, and just like trying to effectively influence the organization. It's been invaluable for my actual like real estate career.
I love that. That's awesome, man. Well, flipping topics just ever so slightly.
Sure.
You are a fund of fund manager. At least that's what you've been advertising yourself as. What does that mean for someone that's just like sitting out as a fund of fund manager?
I'll make it really simple. So if you go out and you're going to go buy a property, like you're going to do this through your own company and you're going to bring in investors into that company to fund the property, you're syndicating a deal. You are putting together a fund, and that is like the primary fund. What I do that's a little bit different is I set up an LLC. I raise money within that LLC from a whole bunch of investors, and then I write one large check to the other guy who's actually buying the property. So he's actually putting together the main primary fund, and I'm just raising my own completely separate fund for the purpose of investing in his fund. So it's like you're another level removed. And so we call that fund of funds because you're not the primary fund. So I raise capital for the purposes of allocating and buying equity in the other guy's company. He raises capital from me for the purpose of buying real estate.
Makes sense. So a couple questions come to mind here. And this is, from my understanding, a relatively newer concept. Yeah. And when you are doing, so first of all, like, are you raising the money and like, is it sitting there waiting for you to deploy it? Are you doing capital calls? Like, how does that work?
So most fund of funds that you've seen in the past, it's usually like on a very large institutional level, mostly for like, hedge funds or whatever. They're raising capital in just like one large pot and then allocating into a whole bunch of different things. The difference is that I start a new LLC, a new special purpose entity or fund, whatever you want to call it, for each property that we want to acquire, that we want to invest in. Okay. So rather than putting together like a blind pool of cash where we're just going to go discretionarily allocate it into deals, I'm raising a new bucket of capital every single time there's a deal.
I see. Okay, got it. So you are effectively syndicating the fundraising, if you will, right?
That's exactly right. I'm playing the role of capital raiser on that syndicator's deal. And there's a few different ways to do that, and I'll explain. So you could either come directly into that primary fund syndication as a co-manager, we call them co-GPs, where you play the role of capital raiser, and then that fund manager decides how much of the fees that you get. Or you can do it my way, where you're completely separate from the fund. You're essentially just a completely separate entity raising money. And with my large check size, because remember, I'm raising money from a lot of people. I'm bringing millions of dollars into the deal in the form of one check.
Right.
I'm using that check to negotiate way better terms in the deal than everyone else who's investing in it. So you will go directly to the deal. You're going to invest your $50,000 and you'll get a certain set of terms and a certain rate of return based on that. I'm going to go to that deal and write them $1 million check, maybe more. And in exchange for that, I'm going to negotiate way better terms for my pool of investors. The impact of that is that my investors end up with much higher rates of return than you, who went directly into the deal.
Well, you just answered my question, which is anyone who's listening, why would they go to you as opposed to going directly to the, and that makes sense, right? So there is power in having
collective bargaining or whatever.
Yeah, exactly.
You get the whole group together. You pool everybody's capital in one large pool. You write one large check. And then with that, you have negotiating power. You've got leverage with the person putting the deal together. You can say, I'll fund the entire deal, but it's going to be on my terms.
What is the typical workflow then? So I'm just trying to piece it all together, right? So as a fund-of-fund manager, I'm assuming that you have an investor list. Yeah. And so are you typically do you typically at any given point in time, do you know how much capital you have to deploy in a certain project, or are you getting the deal sent to you? Then you send it to your investors. And then from that, you go back and you're like, I can bring X amount of dollars to the table.
It's the second one. So, okay. And you bring up a very good point. The first option is for people who have a very long track record and a very long list of wealthy contacts who trust them. And in that case, you just set up one fund, you raise hundreds of millions of dollars in that fund, and then you as the manager can choose discretionarily where to place that capital. You raise the capital before the deal is even there. And that's like the dream for any fund manager to be able to do that. What I'm doing, because I'm not yet at that stage in my business where I can do that, is I'm getting the deal first. So the sponsor will send me the deal, all the information. I'll then send that deal to my contacts, see if anyone's interested. And then I'll take that list of interest and I'll go back to the sponsor and I'll say, hey, I've just raised $1.5 million for your deal. Thank you very much. Here's the cash. I'll take my shares now. And that's how it works. Yeah.
Love it. And I'm sure the conversation goes just like that. That's awesome. So actually, this is kind of a selfish question here because I have a friend who I just had on the podcast, and she is doing something very, very similar to you. And she told me offline that she had run into a situation with one of the project she was involved in where the sponsors ended up taking her investor list, right? So they had these investor contacts. They then basically went behind her back and raised without her on the next project. So how has it happened to you? Or if you don't want to get into those details, that's fine. But how would one mitigate?
Yeah, so there's two things. The way we typically do it is the sponsor never knows who our investors are because we do all of our capital raising internally within Gould Capital, and then we write one check. So the only thing the sponsor sees is a check coming from Gould Capital or whatever our subsidiary entity is, and so they don't actually know who our investors are. Now there are situations. Let's say I'm coming into the deal as a co-manager or co-GP directly into the deal, and I'm doing it that way. Or in the case where I'm just referring an investor directly into the deal because they don't want it to go through me as a middleman. Essentially, you need to make sure that you have some type of side letter agreement or like some legal document in place that says I will be compensated for any investments associated with this name, this list of names, just to make sure that you're legally protected. Because if you don't have that document, then the sponsor's totally allowed to do whatever they want with that name once they have it.
So, and this is where like honestly, my knowledge runs dry. And so you probably are much more knowledgeable about this than I am. How, from a legality standpoint, like how binding are those types of letters? Because it's like, I'm sure that there are many SEC rules and regulations that are like, that make it tricky, that make that sort of thing tricky. Yeah.
Yeah. It's got to be. So first of all, just raising capital in exchange for fees without having a broker dealer license, like a Series 65, is actually illegal. Like that's broker dealering without a license. So you can't do that unless you have the license and you hang that license with like at a shop. The way around that is to actually join the deal as a manager and be what's called an active participant. You can't just be raising capital. You have to have some type of active material role within the operations of that business, that fund or whatever. That's a way around it. The other way around it is to do what I'm doing, which is fund to funds. Essentially, you're setting up a separate entity that you are the manager of, and you can raise capital within that entity and invest that capital into the deal and make fees because, again, you are the manager of the deal. And so those are just two ways around it. But yeah, you can't just serve as a broker dealer and refer people to a deal in exchange for fees. So you got to make sure that you're following the laws first of all, and then if you're following the laws, make sure you have some type of agreement with the operator. The best thing to do if you're coming in as a co-GP is to be added to the operating agreement as one of the managers. Like that's easy to do. Contrary to what a lot of people think, you don't need to resend the operating agreement to all the investors to have them re-sign. You can just essentially like amend the operating agreement to have your name listed as a co-manager. Obviously consult with an attorney before you do this, or you can have some kind of like side letter agreement that adds you as a manager.
Interesting. Okay, cool. Yeah. And that is probably a lot more detail than some people were expecting, but we go deep on this show, baby. All right.
Yeah. I want to keep everybody out of prison, right?
Yeah. You see Wolf of Wall Street? Yeah. Best movie ever. Honestly, I love that movie. Okay, cool. So people listening right now who are active savvy investors, or someone who maybe only 50 grand, 100 grand, whatever to deploy, why should someone invest in real estate syndications or real estate funds as opposed to like other investment vehicles, stocks, that sort of thing?
Oh, there's a million reasons. And yeah, I'm sure you guys have talked about this a lot. I'd say like first and foremost, like real estate is like a hard asset. You can touch it. It's not going to disappear overnight like a stock. It will maintain some kind of value. I think that's like the first thing. The second thing for me, and kind of getting into the whole asset class discussion within real estate, I make my investments decisions primarily based on the hierarchy of needs. And one thing that people, especially working class Americans, will always need is a roof over their heads. And so demand for our product, demand for what we're investing in will always be high. And right now the supply is very behind. I think we're short like 5.5 million housing units. It will be much higher within the next few years because when you have high interest rates, people aren't building because it's just too expensive to build. Other reasons, you can borrow most of the money needed to invest in this stuff. You've heard of a mortgage before. You can go to the bank and they'll lend you a lot of the money. You can't necessarily do that with a lot of other investments like stocks. If you take a look at the risk-adjusted returns over like literally any period of time, I think real estate beats the stock market by like 3 times in terms of like risk-adjusted returns. It's just way less volatile. It moves slower. It's more predictable. There's a lot less variables involved, and it's just I guess a safer investment. Another reason is monthly cash flow. So when you buy into a stock, like, yeah, you might get like a dividend of like a few pennies. It'll be like really, really small. With real estate, you're getting like mailbox money. You're getting actual cash flow every single month, which is super important. The last one I'll mention, just to keep this from being such a long-winded response, is, and the most important one for a lot of people, especially wealthy people, is the tax benefits. So my effective tax rate last year after doubling my income was 3%. Like how? I was domiciled in California where all my peers are paying like between 35 and 50%. It's insane. And it all comes down to depreciation. I'm not going to get into that now because it's such a long discussion. But essentially, the tax benefits that come with owning property make it so that you can essentially eliminate your entire tax bill if you want, or defer that tax bill indefinitely.
While I obviously don't want to spend a ton of time on that either, I do want to offhandedly mention, and I'm sure that you could provide some more depth to this, that there are some investors who get into real estate syndications specifically to take an unfair share of the depreciation schedule, right? To offset their massive tax bill. So can you elaborate on that?
Yeah. It goes into the realm of like bonus depreciation. Just in short, it's a very large paper loss that makes the company that owns the property look like it's losing a ton of money, like on the income statement. It looks like the business is just hemorrhaging cash because you've depreciated the property so much, and it's not like a real expense, and it's a paper loss that the IRS allows you to take. That's the short of it. And so like recent laws, thinking back to like the 2017 Tax Cuts and Jobs Act, introduced special types of like bonus depreciation and stuff that would allow you to take like massive losses on those businesses. And if you qualify, and that gets into the whole real estate professional discussion, you can take those losses from those business activity, those passive losses, and you can apply them directly against your ordinary income that you're making at your job. And so you're essentially you take your income and you subtract those losses, and you could be left with zero or negative. And it looks like on paper, when you submit your tax returns, that you're essentially not making any money, that your adjusted gross income is like zero. And so it's a way to do it. And it's why a lot of people get involved in real estate.
Yeah. And I am sure, and I don't want to go into too much detail here, but have you had experience with like reclassifying or making a separate class of shares in the fund that take a higher rate of that depreciation?
I'm familiar with it and I've seen it done. Yeah. I personally have not been invested in or have raised for deals that do that. The deals that do that are taking advantage of the people who don't really understand how it works or what's going on. And depreciation is one of the largest benefits you can get from investing in these deals. And so a lot of sponsors try to like take that depreciation for themselves or just give it to their top investors and stuff. I don't really believe in that. So.
Okay. Got it. Yeah, it makes sense. There's just, it is, I know, something that can be used for people that like really see the value in it. You know what I mean?
It's a negotiating point. Like it could be, it's like, I'm going to invest $10 million in your $20 million deal. However, like you're going to get that check. It'll be easy for you. However, like I want 80% of all the depreciation benefit or whatever. I don't know the exact mechanics of it, but yeah, that's one of the negotiating points that people have when they're writing large checks.
100%. So you touched on asset classes.
Yeah.
Which asset classes are you primarily invested in? And are there any that you currently don't believe in or would not touch?
So I stick to residential, specifically multifamily. My buy box, I'm looking in Phoenix and Dallas right now, properties that have over 100 units. They're newer than 1980, and they have some kind of like value add component. What that means is that, I can renovate units and raise the rents, or I can like implement a new management process or a team and raise the rents. Essentially ways to increase income at the property, which directly increases the value of the property. So multifamily, the big thing this year, I recently invested in a 100 unit Airbnb fund, just to diversify a little bit. It comes with a lot more cash flow. So a little bit higher risk, a little bit higher cash flow. So it's kind of a trade-off there. But my bread and butter is multifamily.
Love it. Have you ever thought about hotels?
Yeah, I mean, it's interesting. I would definitely have to make sure that the underwriting is extremely conservative because that asset class is just a little bit outside of my risk tolerance. So it would have to be like a really sweet deal.
For sure. Cool. The reason I ask this, I'm getting into hotels. That's really like that's my main focus. So
yeah, just so you know, like if I were to get into like a hotel deal, it would probably. I would need the sponsor to have like 10 or 20 of them full cycle already. Just to get comfortable with it. It's funny. Like, everybody's like, what do you look for in these deals? It's like, it's like maybe 25 or 30% about the numbers. And it's like almost all about the actual sponsor. And if I trust them and like them, that's like really like the whole thing. It's just trusting people.
Yeah. So let's talk about that real quick. So when you're looking at a deal, for everyone listening, by the way, like, this is a consistent theme. Like almost every single person I interview that does something similar to you says the same thing. It has very little to do with the deal itself. Like the deal is the deal, but can I trust and do I know that the main sponsor is going to deliver? Talk about that.
Like at this point, like anyone who's like pitching a deal, like any like experienced company that's pitching a deal, it's probably a good deal, and it's probably been underwritten conservatively, and like I'll obviously check for that. But like it really comes down to like, do I think that this is the right jockey to get the deal across the finish line and outperform? You know, have they done this 10 or 20 times before and outperformed on every single one of them? Like, what about their moral and ethical character? Do I like trust that they're going to be like upfront and communicate with me and be easily accessible and tell the truth? I've worked with sponsors that like were like borderline like SEC like criminals. Like it was so bad, and it's just such a bad experience because you just know that the investors aren't getting the full story. So I need someone who's transparent, someone who I like, someone who I can hang out with. That's really the most important thing.
So when you look at because this is something that, okay, maybe the average investor wouldn't necessarily get exposed to, but even still, what characteristics, how does one make that determination? I guess is what I'm trying to ask, because it seems hard to do.
It takes years. Like you have to go to the conferences, you have to, have the Zoom meetings, you have to be watching these people doing their deals for like months or years, like watch 4 or 5 deals go by before you even start conversations with them. And this is why, people want to work with me, because like I'm the one doing all that hard work. Like I'm going and interviewing all these all these syndicators and going to the conferences and having those conversations on a weekly basis and doing the due diligence, reviewing all the models. It's like, if you want to be a passive investor, like you don't have time to do all that stuff. And so working with someone like me, like you not only get like the higher rate of return because we're negotiating with the sponsor due to our large check size, but you're also getting like years and years of experience and expertise and like due diligence, and like someone who's actually like vetting the deal and putting their own cash behind that as well, because we invest in all the deals that we pitch.
Yeah. So what you just described is basically you have done the due diligence and you've built the relationship ahead of time and spent several years monitoring, conversing with and building that relationship. And that's something that the average investor, someone who has maybe more money than time, wouldn't necessarily be able to do.
Right. Yeah. Like very few have that time to do that.
Yeah. And that's why people like Elijah and myself exist. Yeah,
exactly.
Is to do that, because otherwise you're just doing deals with friends, right? You're just doing deals with family. And basically what I'm hearing you say is that you are creating those friendships, so like those business relationships, but it does take time.
Oh yeah. Yeah, it takes time. I mean, establishing trust is not just like a first time interaction type of thing. It could take 3 to 5 handshakes, sit downs, meetings, dinners, Zoom calls to like even, get to like a base level of like, I think I'm going to do a test investment with this sponsor. Let me just throw 50 grand of my own money into it and see how it performs. Like, are they doing like detailed quality reporting every month? Like, what are the actual distributions looking like? Are they accomplishing their milestones with the renovations? It's like, there's just so much to do before you start involving other people's money.
When you look at when an investor is looking at you and they're looking at this like real estate investing world, maybe they haven't done it. There's a lot of people here in Silicon Valley who I would say invest more heavily in stocks than in real estate. And of course, some of that has to do with the way that they're compensated with their jobs and whatnot. But for those individuals who have more money than time.
Yeah.
What advice would you give to an investor that has more money than time in terms of like how to best leverage the what they have, which is the money, and deploy that? What advice would you give to them?
Do what I do. I mean, I'm in the same situation. Do what I do and invest passively in these awesome syndication deals. You don't need to do all the work to find the property and like be a landlord and a real estate investor. You can just be a passive investor. We call them limited partners in these deals. Now, obviously you're going to be giving up like a lot of the rate of return because you're paying fees to the people who are doing all the work. But you're still going to end up, in my opinion, in a much better situation than having your money invested in stock portfolios. I have like probably 90% of my net worth invested in real estate deals, and it's doing well. And, anytime I've tried to like pick and time the market with stocks, it doesn't do as well. So it's, I would say get involved in these opportunities. If you have more money than time, you're probably, already an accredited investor, or, sophisticated enough to participate in these deals.
So, and that's a great point. Just for anyone listening, like what is the standard definition of an accredited investor if they're not familiar?
Yeah. And it's funny because it's changing. So they're trying to introduce like an exam that you could take to become an accredited investor. Historically, and right now it's you have to have a net worth excluding your primary residence of $1 million or more. You have to be making, if you're single, I think it's over $200,000 a year for the past few years with the expectation of doing it again. If you're married, it's $300,000. Or you can be, a licensed, and there's like 3 different licenses that you could have. You take an exam, you become some type of licensed professional, and then you qualify. You could be a manager of a fund that has like 5 million in assets, and then that qualifies you to do it too. So there's a number of different ways, and you don't need to be accredited for most of the deals, especially the ones that I offer. We can just take sophisticated investors, and they're up to 35 non-accredited investors on each deal. So we can take accredited, we can take non-accredited, and so there's a myth out there that you have to be like worth millions to invest in these deals. You don't. For 506B, which is a special SEC exemption to the rules, you don't need to be a millionaire to invest in these deals.
That's awesome. And let's say someone's listening right now and they're like, I'd like to learn more about Elijah's next deal. How can they find you?
Yeah, actually, the best way to get in touch with me is through LinkedIn. So it's linkedin.com/in/Elijah W. Brown. You can also check out our website. It's goldhawk.us. That's it. And, in both of those places, on my LinkedIn bio and on my website, there are numerous opportunities to sign up for my email list, which will get you access to our deals.
Sweet. Awesome. And we'll put that in the description notes or wherever you're listening. You can find all of those links in the description box down below. Elijah, we're running up on time here. I do have a couple more questions for you. The first one being, what is a belief that you have about real estate investing that is perhaps a contrarian belief, or something that maybe not a lot of people would agree with?
So interest rates are high right now. There's a lot of panic and fear in the markets. People are worried about banking financials and everything that's going on and inflation, what the Fed's going to do next. And a lot of people are sitting on the sidelines. It is perhaps the most difficult time right now to raise capital in like the last 15 years. It is just like so many people are just like hesitant to get in. And my opinion is that right now is the absolute best time that you will see for the rest of your life to buy into the market. Right now, when rates are high and people are sitting on the sidelines, there's a lot of distressed people who have loans coming due, a lot of opportunities out there to take advantage of 20, 30, 40, 50% discounts on these deals. And what do you think is going to happen as soon as the rates come down? Like once rates come down to 5% or lower, how many millennials are sitting out there postponing the purchase of their first house just because like their mortgage doubled, like their payment doubled in the last year? Like a lot, like millions and millions and millions of us are just waiting to buy a house because of that. And so as soon as the rates come down and everybody can afford it, there's going to be a buying frenzy. I think you're going to see values shoot through the roof. The same thing's going to happen in multifamily and every commercial, type of real estate. I think we're going to see a doubling of values within like a 3-year period. And I think right now is the time to get in before that starts happening, before, values start skyrocketing in 2025.
I would absolutely agree with you. I mean, especially with the scale of properties that you're buying, or that you're buying into, I should say, is, I can't think of in our lifetime, I can't think, well, maybe aside from like 08, 09, but like I can't think of a better time in history for exactly the reason that you just said. There are a lot of distressed assets out there. There are lots of them. Have you?
You know what's really great about like our business as opposed to people who are like investing in stocks and other more volatile stuff? It's like we only have to be right like every 10 years, and they have to be right like every year. And so, and you look back in history, like any like 10-year period, real estate has gone up. It's like just place like fixed rate debt with a long-term time horizon and make sure that it cash flows. And you can seriously just sit on it and ride out the storm for as long as you need to. And you can't do that with stocks.
100%. So to conclude here in typical Gould Mine fashion, what is a final golden nugget for anyone listening?
So we already kind of touched on it, and I did prepare this ahead of time. But I have like a small amount of skill in a lot of areas. Like I'm not the best at modeling cash flows. I'm not the best at meeting with investors. I'm not great at drafting emails, making websites and stuff. Like I'm no expert at anything. Like my job is to be the visionary and the leader, and to motivate and influence other people, my team, to implement and to actually like go out and do the work to get the mission done. And this is what the wealthiest entrepreneurs do. They're not doing the day-to-day work. They're not in the weeds of the business, micromanaging and sending emails and doing financial analyses. They are just very, very good at leadership.
Absolutely. And question for you there is what does your team look like right now? So for someone like listening, was like, how does someone get to where you're at, and what does the team look like?
I get this question a lot, and it's funny because if you look at everyone downstream, like all the properties that we own equity in, like you think about all of the staff, like renovating and managing those properties, like everyone on the asset management team, the property manager, the teams, everyone who's like contracted, like echelons below where we are. It's thousands and thousands of people. Our team is thousands of people. However, within our organization, like just Gould Capital as just like a capital raiser, a fund of funds manager, it's really me and my partner Dave are the managing partners. We split the business 50-50. And then, we've brought on a guy named Rick to help us with other things, including investor relations. We have a guy named Aaron and a few others who, we've brought into the organization to help us, on a commission basis. And it's a really lean team. We are a fund manager. We are outsourcing almost every other aspect of the business. So like thousands and thousands of people are working for us, but are, not on payroll by us.
Got it. Well, that's helpful. So what it sounds like, it's you, there's 2 equity partners in the business, and then you have 2 independent contractors and employees, however you want to have people on payroll. That's awesome.
Yeah.
And that team is responsible for an over 2,000 unit portfolio that you have equity interest in, which is pretty impressive.
Isn't that awesome?
Yeah. I want to be like Elijah one day.
And you know what? Those listening, if you want to be a passive investor, it'd be the same thing. You can have interest in like thousands and thousands of units and outsource literally all the work. If you did it yourself, you can make 100% rate of return every year. Like I did that for a while. But you outsource it to everyone else. Maybe you'll get a 20 or a 30% rate of return, but you get all your time back. And that's so worth it. That is so worth it to have your time to focus on what you want to do. So that's it.
Man, that is, and I think that's really the biggest difference between the syndication model and just like being a straight up owner of, a single family or a duplex or a multiple whatever, is people get into real estate investing at a smaller scale, like single families, multi-units, all that sort of stuff. And they think it's going to be passive. And what they realize is
that was me in the beginning. Yeah.
It isn't that passive, is it?
Oh, not at all.
Yeah. And the difference there with the syndication model is that if you really don't have the time to devote to that, but you still want the benefits of being a real estate investor, the syndication model is really like or even a fund is completely changing the way that people are investing in real estate, I think. And this is just the beginning.
And I'd like to caveat that you're getting like direct private ownership. So you get all the tax benefits and some element of control in the deal, right, as opposed to investing in a REIT where you get, no tax benefits, no element of control, and you usually have no idea what's actually, where the money's going or what it's being invested in.
And I think we're going to end with that. Elijah, thank you for your time, my friend, and wealth of knowledge shared
Danny,
today.
it was such a pleasure. Thank you so much for having me on.
All right, my friend.